All right, so everyone's been buzzing about this, right? The Fed's latest move on interest rates, it's September 18th, 2024, and they just threw us a bit of a curveball. Did they totally cave to market pressure, or is there more to this story?
Yeah, it's definitely got people talking, that's for sure. A lot of head scratching going on out there.
To say the least. Okay, so let's break it down. First up, this jumbo rate cut half a percentage point. We haven't seen a cut this big since, what, the beginning of the pandemic?
It's huge.
Yeah.
And, it really makes you think, considering they've spent the last few years steadily raising rates, this is a big shift.
Exactly, a total U-turn, which makes you wonder, why now? I mean, the economy seems to be doing all right, from what we keep hearing at least.
Right. And that's where it gets interesting. Remember, the Fed's got this balancing act, right? Keeping inflation in check, but also making sure people have jobs. It's a tough line to walk.
It's all about finding that sweet spot.
Exactly. And while inflation has cooled down a bit recently, it doesn't seem like the Fed's ready to declare victory just yet.
They're not popping the champagne just yet.
Not a chance. I mean, even Powell himself said, we're not at 2% yet. We're certainly not saying mission accomplished. So, yeah, they're being pretty cautious.
Cautious optimism, maybe? But what does this all mean going forward? Are more cuts on the horizon?
Well, if you look at the Fed's dot plot, which is basically their roadmap for interest rates, it seems like this cut might just be the tip of the iceberg.
Wow, so even lower rates are on the table. This is huge. But I'm guessing not everyone's on board with this approach.
You're right, there's always dissent, even within the Fed. Michelle Bowman, one of the Fed governors, actually voted against such a big cut. She wanted to take a more cautious approach.
It's always fascinating to see these internal disagreements play out. Shows you there's no magic formula, right?
Exactly, everyone's got an opinion. But okay, so more rate cuts might be coming, but what does it all actually mean for, the average person? The million-dollar question. Well, there's good news and potentially not so good news. A rate cut like this can trigger a domino effect, potentially leading to lower mortgage rates, car loans, that kind of thing.
I've even heard that mortgage rates are already starting to dip in anticipation of this.
Yeah, the market reacts fast. But on the other hand, remember those decent interest rates you've been getting on your savings account? Those could shrink too.
The classic trade-off. Cheaper borrowing, but maybe lower returns on savings. Ugh, why can't it just be easy? Speaking of things that aren't so easy to predict, did you notice how Bitcoin jumped right after the Fed made their announcement? What's the deal with that?
Oh yeah, that was interesting. It really highlights how interconnected everything is, especially in the financial world. Basically, rate cuts often give a boost to what are called risk assets, and Bitcoin, being the volatile friend it is, definitely falls into that category.
So when the Fed cuts rates, it's like they're saying, hey, risk takers, come on down.
Something like that. It's like a green light for investors looking for potentially bigger gains. And get this, it's not just happening here. We're seeing central banks around the world joining the rate-cutting party.
A global trend. But I'm guessing not everyone's convinced this is going to end well.
You said it. Some experts, like Arthur Hayes, he's a big name in the crypto space, are even saying these rate cuts could actually be the catalyst for a market crash down the line.
Whoa, hold up. A market crash. Now that's a bold statement. Okay, so let's unpack this. Did the Fed cave to pressure? Question a bit more. I mean, it seemed like everyone and their dog was anticipating this rate cut. Is it really a coincidence, or is there something else at play?
That's a good question. And it's not so black and white, unfortunately. Remember how we were talking about the Fed's dot plot, their interest rate roadmap? Well, traders were placing bets on what the Fed would do, right? At first, most thought it would be a smaller cut, like a quarter of a point. And then suddenly, the mood shifted. A half-point cut became the popular bet.
So the market threw a tantrum and the Fed just caved.
Well, it's probably more nuanced than that. Ideally, the Fed should be basing their decisions on economic data, not just market whims. And Powell, to his credit, when asked directly about this, was very careful with his words.
Oh, what did he say?
He emphasized that the Fed's always going to do what's best for the long-term health of the economy. Now, did he outright deny bowing to market pressure? Not really, but it was a very diplomatic, very Fed-like response.
Classic. Never a straight answer from the Fed. But you know what's really interesting? It's the fact that there was so much uncertainty surrounding the decision in the first place. I always thought the Fed was usually a bit more, I don't know, transparent about their plans.
I know what you mean. Usually they're much clearer about their intentions. This time around, there seemed to be a lot more internal debate, less consensus, which is unusual.
Oh, it's like they were deliberately trying to keep everyone guessing. But okay, so we have this big rate cut, a lot of uncertainty still swirling around, and the potential for some pretty major global impacts. It's a lot to take in. So before we get too far down the rabbit hole, let's bring it back to what matters most. What does this all really mean for the average person? What does it mean for the people listening to this right now?
You're right, let's bring it back down to earth. Think of it this way. The Fed's decision is like throwing a stone into a pond. Those ripples spread out, impacting everything in their path.
Okay, I like that analogy. So walk us through those ripples. What are some of the tangible effects of this rate cut that our listeners might actually feel in their own lives?
Well, the most immediate impact will likely be felt in the housing market. Lower interest rates usually translate to lower mortgage rates, making it, easier and maybe even a bit more tempting to buy a house.
Which, like we were saying earlier, seems to already be happening even before the rate cut was officially announced. Just the anticipation is enough.
It's true. The market reacts to even the slightest hint of change. But it goes beyond just buying a house. Think about it. If you're thinking of financing a car, finally renovating that kitchen, or even just consolidating some debt, the cost of borrowing money is likely going to be a bit lower than it would have been otherwise.
So, potentially some welcome relief for anyone looking to make a big purchase or refinance those existing loans. Yeah.
Exactly. However, and it's a big however, it's not all sunshine and rainbows, unfortunately. Remember those decent interest rates you've been enjoying in your savings account? Yeah, those might take a little dip too.
Right, there's always a trade-off. Cheaper borrowing often means lower returns on savings. It's all a balancing act, isn't it?
Always. And then, of course, there's the ripple effect on investments. We touched on how rate cuts can give a boost to risk assets, like our friend Bitcoin. But let's dive into the why a bit more.
Yeah, I think it would be helpful to really understand the mechanics of that. Why exactly do lower interest rates make riskier assets more appealing to investors?
It boils down to this. Investors are always on the hunt for the best possible return on their money, right? When interest rates are high, safer investments, things like bonds, become more attractive because they offer a decent return without as much risk. But then, when interest rates drop,
Those safe havens aren't so appealing anymore.
precisely, investors who are looking for those bigger gains start looking elsewhere. And that often means turning to riskier assets, things like stocks or even, you guessed it, cryptocurrencies, in hopes of a bigger payoff. And as demand for these assets increases, well, so do their prices.
So it's like this chain reaction. The Fed cuts rates, investors get antsy, and suddenly Bitcoin's having a moment in the spotlight.
That's a pretty good summary. But it's crucial to remember that riskier assets are, well, inherently riskier. While they might hold the potential for bigger rewards, there's also a greater chance of, things not going according to plan.
It's a double-edged sword for sure. Which brings us back to that warning from Arthur Hayes. He seems to be pretty convinced that these rate cuts could actually create enough instability in the market to trigger a full-blown crash. What are your thoughts on that?
It's definitely a thought-provoking argument. What he's suggesting is that these rate cuts could shrink the gap between borrowing costs for different currencies, like, say, between the US dollar and the Japanese yen, for example. And that could lead to investors scrambling to adjust their portfolios, which, as you can imagine, could create some chaos.
I can see how that could lead to some pretty major upheaval in the markets.
Exactly. It's like pulling a loose thread on a sweater. It might seem small at first, but pull too hard and the whole thing could unravel.
So we've got these potential risks looming on the horizon, but then there's also the more immediate question that we started with. Did the Fed actually give in to all that market pressure with this rate cut?
That's the million-dollar question, isn't it? And unfortunately, it doesn't have an easy answer. Powell, as we've discussed, has been very careful not to outright admit to that.
A masterclass in diplomacy. But it's hard to ignore the fact that the market seemed pretty darn sure a rate cut was coming, and then, what do you know, it happened.
Right, and that's what makes this whole situation so intriguing. We have the Fed's official line emphasizing their commitment to, maintaining a stable economy, keeping inflation in check.
Which, to be fair, are perfectly reasonable goals.
Of course. But then you have this backdrop of market expectations and the very real possibility that those expectations themselves influence the Fed's decision-making process. It's a bit of a chicken or the egg situation.
Like trying to solve a puzzle where the pieces keep changing shape.
Exactly. And that's why it's so important to look beyond the surface, to really dig into the nuances of the situation.
Understand the forces at play and what they might mean for the road ahead.
Couldn't have said it better myself.
It's like we're trying to read the Fed's mind, you know? What are they going to do next?
It's a bit of a guessing game, that's for sure. Trying to decode their every move and figure out what it all means. But that's why it's so important to stay informed, keep asking those questions.
And that's what we're here for, right? Trying to connect the dots and make sense of it all. But with all this talk about more rate cuts and, even potential market crashes, it's easy to get lost in the weeds a bit. Let's zoom out for a second. What's the big takeaway here for our listeners? What's the one thing they should really hold on to after this deep dive?
I think the most crucial thing to remember is that the economy is, well, it's a living, breathing thing. It's constantly in flux. What holds true today might be ancient history tomorrow. The Fed is always adjusting, fine-tuning their approach based on the latest data, trying to anticipate those risks and opportunities that are always popping up.
So it's not just about this one rate cut, it's about understanding the bigger picture, right? This constant push and pull that the Fed's always navigating.
Exactly. And speaking of the bigger picture, remember how we were looking at the Fed's dot plot, those future rate projections? Well, there's one more little nugget buried in there that I think is worth mentioning. The Fed has also hinted that they believe the neutral interest rate, basically the rate at which the economy is humming along nicely, not too hot, not too cold, that neutral rate, they think it's actually higher than the rates they're currently projecting, even after all these cuts.
Hold on, just want to make sure I'm following this. They're cutting rates now, but they're also thinking they might need to raise them again later to get to this neutral level.
That's one way to interpret it. It suggests that maybe they're tapping the brakes now to avoid a potential crash later down the road. But eventually, they'll need to ease off those brakes again to keep the economy moving at a healthy, sustainable pace.
It's all a balancing act, and it sounds like this rate cut saga is far from over.
Oh, absolutely. We're just in the early chapters of this story. And as always, the best thing you can do is stay informed. Keep your finger on the pulse of those economic indicators and never stop asking questions.
Couldn't agree more. Knowledge is power, after all. Well, we've certainly covered a lot of ground today. From jumbo rate cuts and their ripple effects across the globe to the potential for both economic booms and, let's face it, potential busts. It's been quite a ride.
Tell me about it. But that's what makes economics so endlessly fascinating. It's complex, it's always changing, and there's always something new to learn.
And we'll be here right alongside you every step of the way. Thanks for joining us for this deep dive into the wild world of Fed rate cuts. Until next time, keep those brains engaged and stay curious.